What's up, everyone? OG John AG here. We just witnessed another intense plunge in prices overnight. Silver plummeted to a low of $71 per ounce, forcing even more positions to be liquidated. Gold touched a low of $390 before finding a foothold and rallying, resulting in a massive upward swing. As I record this before the market opens, silver has rebounded from $71 to $83. That is a powerful 17% surge off its lowest point. Gold has reclaimed $250 of the $450 it lost. From the intraday bottom, gold is now up 7%, while silver has advanced 15%. These are solid moves, but the volatility is extreme, and all eyes are now on the opening of the New York trading session. In my recent updates, I outlined precise potential scenarios for silver, using Bitcoin as our primary leading indicator. The rationale for this is straightforward. Whenever a major shift in overall market risk sentiment occurs, cryptocurrencies, and Bitcoin in particular, frequently lead the move, offering us a vital early signal for commodity assets such as silver. My specific instruction was to monitor whether Bitcoin closed the weekend above or below the $82,000 level. I stated that a close beneath the $80,000 to $82,000 zone would likely lead to that selling pressure spreading to other markets. It closed at $76,000. Its lowest point was $74,500. I explicitly warned that a test of $74,000 or lower would confirm substantial market weakness. Please go review the prior video. This is not a retrospective narrative. This framework was the foundation of my cautious outlook. And what transpired? We witnessed that precise spillover effect. Silver was hit hard, dropping to $71. Subsequently, we saw a relief rally, a 17% move back to $83 in silver. Now we await the New York Open to see if this recovery holds firm or if the bearish narrative resumes its course. I read every single comment on yesterday's video. Thank you. It is incredibly powerful to see you utilizing this analysis to make more informed and decisive moves. The division in viewpoints was evident. Some of you are positioning for another potential downward leg, while others remain steadfastly anchored in the long-term macroeconomic thesis. This split does not indicate confusion. It reveals a community of prepared individuals, each executing their own distinct strategy. That is the essence of what we cultivate here. Independent thought, not blind herd mentality. We do not traffic in fear, greed, or Netflix-style hype about overnight fortunes. This is not a scripted production with a guaranteed happy ending. These are real markets involving genuine risk. Now, a crucial reminder for everyone, particularly those who are new. I do not sell trading signals, online courses, paid mentorship, or any form of subscription service. Anyone claiming otherwise is attempting to scam you. Block and report them immediately. My sole function is to deliver a clear, unfiltered perspective on market dynamics. I operate exclusively on X and YouTube under the handle eRogJohnAG on both platforms. That is the only source for my market analysis. I am not affiliated with any other accounts or groups. Protect your capital and your personal information. I will never solicit money from you. Now, let's examine the current data as I'm recording this pre-market. Shanghai Spot is trading at 199. SHFE futures are at 142 on. Western Spot is at 8347. Western futures are also at 8347. The premium sits at 1852. That translates to a 19% premium. This is down from the 43% premium observed over the weekend, but it remains a significant 22 to 23% premium in the pre-market. The volatility is wild, and we are all waiting for New York to begin trading. Here is what unfolded overnight and this morning. Approximately $10 trillion in market value has been erased in just 3 days. Gold is down 20% from its peak, wiping out $7.4 trillion in market capitalization. That figure is 5 times the entire market cap of Bitcoin. Silver crashed nearly 40%, obliterating 2.7 trillion, an amount equivalent to the total capitalization of the entire crypto market. Traditional safe haven assets are behaving with the volatility of cryptocurrency meme coins. This is the continuation of the sell-off initiated under Fed Chair Kevin Walsh. However, a key factor makes this distinct from a typical market crash. Central banks did not begin selling their gold reserves. Tether did not sell its gold holdings. The U.S. government did not unveil a credible plan to meaningfully reduce its debt. In fact, the U.S. government has shut down because it cannot resolve its spending disputes. So why is gold undergoing such a violent sell-off? There appears to be a growing disconnect between the various markets that trade gold. But the second, more critical reason is that a major entity requires liquidity urgently and is selling gold assets to raise cash. This implies a great deal of paper shuffling is occurring because absolutely nothing in the fundamental macroeconomic backdrop has changed since last Thursday, aside from the possibility that the banking system has hit a major stumbling block. The manner in which gold is selling off concurrently with equity futures and Bitcoin falling, yields dropping, and the dollar beginning to show strength is not normal price action. It is a signal of market stress. When gold is sold in this aggressive, indiscriminate fashion, it typically indicates that something in the financial system is under severe pressure and may be close to breaking. This is characteristic of a liquidity crisis. In a true systemic margin call event, large funds do not sell what they prefer to sell. They sell whatever they can sell quickly. Gold and silver represent liquid, profitable positions for many institutions, making them the first source of capital to be raided when the margin clerks start making their calls. Now, here is the conclusive evidence that proves this is a paper market manipulation, not a reflection of physical fundamentals. In Singapore and Australia, people are queuing to purchase gold, not silver, as it is broadly sold out. In Hong Kong and China, no queues are reported simply because premiums are exceptionally wide and supply is scarce. Silver is also broadly sold out there. In Europe, dealers have withdrawn their offers to sell silver. Individuals were still lining up to buy gold in Singapore even as prices crashed, demonstrating the remarkable resilience and strength of retail demand for tangible precious metals. Looking at the analytics, approximately 75% of you watching this right now are not subscribed. If this unfiltered real-time analysis is helping you cut through the market noise, please hit the subscribe button. If this content adds value to your process, drop OG John AG in the comments below. I am here for those who seek clarity and substantive insight, not polished, empty hype. The reserve in Singapore, one of the planet's largest private silver vaulting facilities, reports that physical silver demand actually increased during last week's price crash. The reserve observes a widening chasm between the paper and physical markets and anticipates physical shortages to intensify. Meanwhile, the current listed price for silver on JD.com, China's premier e-commerce platform, is $163.35 per ounce today. On the COMEX, it is $83. That represents a 95% premium. Let that magnitude sink in. JD.com, 163. COMEX, $83. A 95% premium, and silver remains in backwardation. You cannot resolve a massive physical shortage by artificially suppressing the paper price. This manipulation has zero correlation with genuine physical supply and demand. Its purpose is to forestall a Western financial crisis stemming from decisions made by those in authority. This is becoming incredibly obvious. Whatever is unfolding behind closed doors must be truly momentous. Silver persisting in backwardation signifies a shortage of deliverable physical metal, meaning all these paper short positions will eventually have to arrange for physical delivery. The players involved are engaging in an exceptionally perilous game this time. We are in the midst of a precious metals revaluation process where exchanges like COMEX and the LBMA are being systematically drained of physical gold and especially silver. All the short sellers currently care about is maintaining low paper prices while attempting to cover their paper shorts and minimize losses. When this process concludes, the full revaluation will unfold, and silver, in particular, will trade at substantially higher levels, likely achieving a gold-to-silver ratio of at least 15:1. What is striking is how the net volume data on silver futures at COMEX continues to tell a completely different story. Yes, concerted efforts were made to crash the price throughout last week until they succeeded. However, the overall volumes so far are almost balanced outside of those large, aggressive sell orders. This indicates the price is being driven lower by a combination of spoofing, mostly in overnight hours, and wash trading during U.S. market hours. This forced the price down, which then triggered the unwinding of derivatives linked to large ETFs like SLV and particularly leveraged instruments like AGQ, creating a flush through stop-loss orders. Needless to say, this activity has no connection to the physical market, where fundamentals remain unaltered and the physical shortage continues to intensify. SHFE silver vault inventories are stable. The Shanghai gold parabolic trend remains technically intact, though it needs to find support and bounce here. SHFE silver futures hit the daily limit down of 17%, causing the contract to lock at the lower price limit with intense, one-sided selling and very limited, effectively non-existent, two-way trading for the rest of the session. That informs you the Chinese futures market is also under significant stress. But critically, the physical vaults are stable. The premium is holding firm. The physical market is not breaking. Only the paper market is breaking. Now, let's discuss what the New York Open might bring. We have two primary scenarios. First, the bearish case. If New York opens and the aggressive selling pressure resumes, we could see silver retest the $71 level or move even lower. The 17% bounce from $71 to $83 could merely be a temporary relief rally before further downside. New CME margin requirement hikes took effect today. If traders cannot post the additional capital, more forced liquidations will follow. Bitcoin at $74,500 already confirmed the weakness I forecasted. If it breaks below that level, it will spread risk-off sentiment to virtually all asset classes. A staggering $9.6 trillion of U.S. marketable government debt is set to mature within the next 12 months, the largest amount ever. This is double the figure seen prior to the 2020 crisis. It accounts for 33% of all outstanding debt, one of the highest percentages in recorded history. The majority of this debt must be refinanced at considerably higher interest rates. The U.S. debt crisis is entering a new, more dangerous phase. This creates systemic stress capable of triggering waves of selling across all markets. We are watching the everything bubble pop in real time. The S&P 500 is trading at its most expensive valuation multiples in history, exceeding even the peaks of 1929 and 2000. A reversion to the mean here would be terrifying, yet it is historically expected. Past cycles tell us that during a deflationary crash like 2008 or March 2020, precious metals initially get dragged down alongside equities. The bottom is typically in when the selling in metals halts, while equities continue to fall. Until that point, the global deleveraging process will be brutal. That is the bearish scenario for the New York Open. But here is the bullish case. The bounce from $71 to $83 is holding in pre-market trading. If New York opens and this upward momentum continues, we could witness silver reclaim the $87 level, even testing $90 by the end of the day. Sharp, violent drops are engineered to trigger panic and fear. That is how markets shake out impatient, weak-handed money. Gold and silver have just experienced a significant pullback, but the overarching macro backdrop remains unchanged. Soaring debt, rampant deficits, geopolitical tensions, monetary system uncertainty, all these factors are still present and accelerating. Corrections within a longer-term bull market are normal and healthy. High volatility does not equate to a reversal of the primary trend. Silver is nowhere near a speculative top or bubble. It remains severely undervalued relative to equities. The gold-to-silver ratio currently sits at 57.1. The historical average is near 15.1. The COMEX vault ratio is approximately 112. The mining production ratio is about 1.8. The LBMA vault ratio is around 1.3. The ratio of all available above-ground silver to gold is roughly 1.1. Fundamentals will inevitably regain control of the pricing mechanism. When that transition occurs, silver will explode higher to catch up to these stark ratios. It is vital to understand that in Western gold and silver markets, there are exponentially more paper claims on metal than real deliverable metal. This sell-off represents a paper dump designed to fool the general public into avoiding metals just as the equity market prepares for a collapse. Observe how unstable the paper gold price is. But physical buyers globally know better. The queues in Singapore and Australia, the sold-out status in China and Hong Kong with wide premiums, the 95% premium on JD.com. This is the physical market overwhelming the paper market in slow motion. Furthermore, Bank of America's Bull and Bear indicator is registering one of the most extreme bullish readings in its history. From a contrarian investment standpoint, such pervasive bearish sentiment often marks major bottoms, not tops. For those who perceived value in silver at $120 last week, the current price near $77 may represent a substantially improved risk-reward proposition. That is the genuine opportunity being presented by this extreme volatility. Silver is down another 9% from Friday's close, but from the $71 low, we are already up 17% to $83. So what key elements am I monitoring as New York opens? First, does the bounce from $71 to $83 hold, or does it fail, leading to a retest of $71? Second, does Bitcoin stabilize in the $74,000 to $76,000 range, or does it break to new lows? This will indicate whether the selling pressure is exhausted or if more is to come. Third, do equity markets find stability, or do they gap down aggressively and drag precious metals down with them in a correlated sell-off? Fourth, does the Shanghai premium hold at 22%, or does it compress? If it compresses toward 10% or lower, that signals physical buying interest may be waning. If it holds or expands back toward 30-40%, that signals physical demand remains voracious and the paper market is losing its grip. Fifth, do we receive any significant news regarding banking sector stress, a resolution to the government shutdown, or escalating tensions with Iran? Any of these headlines could move markets violently in either direction. Where does this leave us? Number 1. The physical and paper markets are entirely disconnected. Queues in Singapore and Australia to buy as prices crash. China and Hong Kong sold out. A 95% premium on JD.com. Silver still in backwardation. SHFE vaults stable. This is not a fundamental breakdown. This is paper manipulation and forced liquidation. While physical demand increases, the divergence between paper and physical is expanding, not contracting. Eventually, one of these two markets will break. History consistently shows it is the paper market that breaks, not the physical. Number 2. The New York trading session will inform us whether $71 was the definitive bottom or if more selling lies ahead. The 17% bounce to $83 is an encouraging sign. Gold is up 7% from its lows. Silver is up 15%. But we require confirmation from the New York session. If the bounce holds and builds momentum, the worst of the selling may be behind us. If it fails and we retest $71 or go lower, more pain is likely before a final bottom is established. Watch the open closely. The core unresolved tension is this. Silver hit $71 and then rallied 17%. But will New York confirm this as the bottom? Or is this merely a relief rally before further downside? The physical markets are screaming undeniable strength, cues, massive premiums, backwardation, sold-out dealers. The paper markets are screaming intense stress, forced liquidation, margin calls, wash trading. Which one will prevail when New York opens? Always conduct your own thorough due diligence and fully comprehend the risks, as this volatility is extreme. Trading with leverage under these conditions carries exceptional danger. Think for yourself. Utilize your own critical judgment. Do not follow any analysis blindly. This involves real, substantial risk. While some are observing a significant divergence where paper market selling contrasts starkly with physical market tightness, it is critical to interpret this dynamic carefully. The recent low of $71 may present a potential entry point for some strategies, but it could also simply be a pause before further decline. New York will provide the answer. Stay sharp. Watch the data flows intently. Invest based on logic and evidence, not on hype or emotion. OG out.